Good day, traders. The 4-step method to high performance trading and the free audio program, the 7-step daily routine for high performance traders, are both free downloads to help you develop the skill set, the mindset, the discipline to master the markets. The link is down below in the box, the description box. They're both free downloads. Let's get started.
Good day, traders. Stacey Burke from Stacey Burke Trading, and today we're going over what I consider to be the key component to trading with the banks, trading with the smart money, and that's the 3-day setups. Everything in the playbook builds around 3-day setups, and that's separate from day 3 breakouts, but 3-day setups are rampant, and I talk about Monday starting the week. We can have other 3-day setups that build around there, but inevitably we get a 3-day setup that can coincide with the economic calendar and holidays, several opportunities. Today was this whole month, really since the beginning of the year, has been almost textbook perfect opportunities. And again, I reinforce the mindset to step back and allow for the bigger picture to set up and to understand the importance of timing. Many times a lot of traders are emailing me and asking me about certain setups based on price action alone, and I reinforce the critical nature of understanding the timing, 15-minute and hourly rotations, and just having the patience to let the market set up for a best trade setup, because when these patterns complete, that is when you have sizable opportunities to scale in and really maximize a profitable trade setup. So I reinforce the importance of studying the playbook right from the beginning of the week. Monday opening range, Tuesday initial balance. That typically will set the high and low of the week. And then understanding the 3 things that markets do. They will break out, pull back and trend. They will break out and fail and reverse, false break reversal. Or they will trade between a high and a low of the week in a trading range. These large moves will come after 3-day setups. The market will tend to build up a box, and that starts right from the first session of the week, where Asia will build a box, and over the course of the day, Asia and London will now build a box, perhaps expanding the range. And then we have maybe even from the previous day a US, Asia, London high-low that now sets up for a 3-session setup on day 1. But over the course of 3 days, we will see large moves build. We had Martin Luther King Day on Monday, Dow Jones. We had a brilliant first red day trade on Tuesday, our day 2. So remembering that Monday, Tuesday, by the time Monday, Tuesday has printed, one of those extremes may be in place for the week. Now, a trader asked a great question. Why did the S&P and the NASDAQ not break down like the Dow did on day 2, on Tuesday, for the first red day? I cannot answer that. I can only identify which instrument has the potential to be a best trade setup. Now, if I traded NASDAQ, S&P, as we talked about yesterday, they were high of the week, high of the day, high of the session, sell opportunities, trading back down to the low of the session. The Dow was a broken down market. Broken down market for a short trade is a pump and dump setup. As I reinforced yesterday, and I will repeat this again today, every trade that I take in some capacity, when I enter that trade, it is either a pump and dump or a dump and pump. If I'm selling the market, it is a pump and dump setup, regardless if it's a 3-day setup, a 3-session setup, high of the day, high of the week, low-hanging fruit setup. It will be a pump and dump if it is a sell trade. If it is a buy trade, it will be a dump and pump. Regardless, it will always be a dump and pump. That is the nature of how these setups will work. When you piece this together, you will start to understand the entries for timing these and giving them and having the patience instead of getting caught into impulsive, fast price action and getting in early, understanding the importance of time rotation, and then asking yourself, if it's a dump and pump, have they locked in the low? Have they coiled and locked in the low for me to enter this market now? We had some specific criteria that we talk about in the playbook and the basic entry model that we go over. Everything boils down to planning, preparing, and executing. So when you have a plan in advance, you then will have the patience. Number one, if there's news on the calendar, there will either be a first bounce opportunity, and if it is, it may be the end of a move or taking you into the extreme. Remember, whenever a market gets to its high or low, whether it's the high or low of the week, the high or low of the day, whatever that may be, that is where it becomes the most vulnerable to a reversal or a continuation trade. So if you're in a profitable trade, don't be scared to lock in the money. If you're in a first bounce trade and now we're heading into a new hour or just heading into an equity market open, be prepared to either lock in the profits or now be identifying how this market may need to trade in order for you to have an entry into the market. We've talked about the basic model for trade setups and how to enter them. The basic model is across the board. That is your safest, easiest mechanism that I set up for traders. Obviously, we can go down to the 1 minute, but this was the basic model for entering into these trades. I talked about with the U.S. indexes, I only specifically look at the New York session. And if you step back and see where these larger moves occur in the U.S. session, then you start to understand that the whole day starts to build a box on the day. Now we had day 1, day 2, day 3 breaks down and coils sideways. And I mention this and try to reinforce this as well. When you head into the close of a day, draw your consolidations. If your consolidation changes, if they break a level or make a lower high, redraw your consolidations heading into the U.S. session. That is your box. If they break down, look for the pump up for the short trade. We're in consolidation. If they pump it up into the high. Now for traders who were looking to go long, remember, identify these spaces. Think to yourself, if this market was to break down, look at the space. This is not a short squeeze. So a good question from a trader was, he identified this as a short squeeze. This would be inverted and be pushing into the low for the short squeeze vertically. We will look at a specific example of a parabolic short squeeze on the Canadian dollar. But day 1, day 2, day 3. Pump up first red day, broken down market on day 2 for the high of the session, high of the London day, peak formation, short trade, and collapse. Day 1, breakout traders in the market. Day 2, breakout traders in the market. Peak formation high, 1 push, 2 pushes on the news, and a 3rd push at the New York Open. When there is an 8:30 U.S. session, major red news on the calendar, think 9:30. After 9:30, New York time. And then think about time rotation. First hour has news. Second hour is the market open. Third hour could be the trade. If it's not, has this market broken down or is it breaking down? 1 push, 2 push, 3 pushes into the high, peak formation high, and the collapse. And coming back to some simple concepts, the whole high-low is one geometrical structure for a full measured move. This box still could have a full expansion drop lower. Don't know, not a prediction, but just in terms of classical charting principles, we had a large consolidation that was broken out of, breakout, pullback, pattern within a pattern, New York Open, peak formation high after the news, 3rd push to the high for a collapse, continuing in the original short trade direction. NASDAQ and S&P. So for the trader that asked why these two indexes did not break down, again, I don't know why they did or didn't, and don't care. It's a more understanding, it doesn't matter why. It's, do you have a setup? And so day 1, again, Monday forms our opening range high-low. Tuesday expanded the range with a false break high of day, New York session, short trade. we had, again, comparing the two, we did not have a breakdown in structure on NASDAQ, so you're trading down into the low of the session. High-low, first hour forms a high-low. They break out at the New York Open, lock in the high for the reversal trade back down. That's our initial balance now. That is our high-low of the week. On day 3, we have one push, two pushes, lower high, and then 1, 2, and a third push to the high on the third day for a 33. So several traders have asked about the 33 trade. Also, 33 trade is 3 pushes on the third push to the high on the third level, third day. All the threes you can call 3,333. But it's 3 pushes on the third day, third level. And remember, on level 3, day 3, it will often blow off in the direction of the trend. That's what gets traders chasing the move. False break. So we have our peak formation on Monday, putting in a low of the week and a high of the week. They expand the range. They trend in the direction of the high of the week. False break starts our day count now down in the other direction. Day 1. So this third day now becomes our day 1. Just want to show this again. We take the bodies for a measured range expansion mirror image. That's all it is 100% expansion of the range. We, again, could still be continuing lower. And we have a possibility of that because we know there are traders in the money. S&P, so again, our pump-up day was on Friday. We talked about the high of Thursday after CPI put in a high that the market has been working up into our opening range on Monday. Day 1, opening range. Day 2 expands the range with a false break, high day short trade. Again, no break in structure on day 2, but we get the break in structure today. Break in structure is the breakout of the low of the day. That's the break of structure on the inside. Day 1, day 2, day 3, break of structure on the inside. We will often see this on the inside bar as well. In this particular case, day 2, Tuesday, we had the higher high that took out the Monday. The break in structure is the break of the low of the day, starting our pump up on day 3. 1 push, 2 pushes, 1, 2, 3. Third hour for the collapse. And again, coming back to our rectangle, bodies, high, low, we can use Monday, Tuesday, we can use the high-low bodies of Monday, Tuesday. We get a full range expansion minimum, taking out Friday's low and possibly heading lower. Don't know. Won't know until I come to the U.S. session tomorrow. They might have already been down there. But again, day 1, day 2, day 3, Monday, Tuesday, Wednesday, pump up day Friday, pump it up, keep it up there, and collapse. Canadian dollar, Monday, Martin Luther King Day. And that is our opening range. Inside day, they break out on day 2 without taking out the high of the week, high bull major resistance of Friday. And then drop it down 3 levels. U.S. session sell high setup on day 2, which becomes our first red day. Now I want to go over this. Just a couple of things I want traders to identify. On Monday, when the market trades back up and we have Martin Luther King Day, we have a low made in the London session. The U.S. volume stays up high. On day 2, all of the volume is on the upper level above double zeros. So what that means is there's a space underneath. 3 levels of rise. 3 levels of rise with space underneath. What that means is that if that market fails and collapses, we get a vertical, no stress, easy short trade that we had in the U.S. session. That became our first red day. So again, hindsight pays because that's what tells me what my thesis should be going into today. We have a first red day, high of session, high of day opportunity for Asian session traders. So we redraw our consolidation, redraw our consolidation. And those who are using numbers, just be visually aware that's a 25 pip consolidation, a 25 pip box consolidation that breaks down and collapses into the open of the Europe session. So For traders who are looking for the first red day trade down low, remember it is a high of the day, high of the session opportunity. Now coming back to our box, if Asia has put our high of the day in, and we have one push, two pushes, and a third push down before we get a break in structure, this break in structure nullifies the first red day opportunity. It's over. One push, two push, three pushes into the low of the week. We have low bear, major support. What should you be thinking? Parabolic short squeeze. Asia makes the high, London puts in the low, we go sideways in consolidation. We have major red news on the calendar. We will either get an explosion one way or the other, an explosion for a first bounce trade opportunity entry after major red news, which we go over in the playbook very specifically. If not, my next thesis is 9:30 New York Open. We get our break in structure. Break of structure on the inside. Think dump and pump. V bottom. If it's a dump and pump, break in structure, it's a long trade opportunity in line with our short squeeze thesis, engulfment, and also fitting our 5-minute entry criteria. And just also recognizing, again, 1, 2, 3 levels of drop, break in structure, short squeeze for the vertical parabolic short squeeze. Monday, we had again, Martin Luther King Day, broke down first on the Swiss franc. We had a first red day yesterday. Day 2, first red day, first day that closed down. We have a pump up day on Monday that goes into consolidation on level 3 before breaking down, lower low, lower high. The U.S. session forms our high low. They stay in consolidation. We get a break in structure right at the rollover and 3 pushes into the high of the day before engulfing, heading into our Europe Open. 3 sessions, U.S., Asia, London, 3 levels of rise from the low of the day for a first red day collapse in the Europe-London window. Back up the truck and load it up. We have 2 full expansions of the range with the low-hanging fruit continuation, which is just a blow-off. So for traders who are looking for that down low, recognizing 30 to 40 pips of profit after the major red news, still was there within reach on the continuation for the measured move of the first red day trade. Japanese yen, we had the first green day on Monday, false break reversal. So again, something to think about is that whenever you get a breach of a Friday, if it's high or low of the week, at the beginning, right on a Monday, and it's a false break, always recognize that they now have other time frame traders triggered into the market right at the beginning of the week, and then you can start your day count. They may be there for the rest of the month or the rest of the week, but when we see a market not fully complete, which we'll take a look at an example of that in a second, those traders are now trapped. So, for example, we had traders short at the breakout. This market reversed, went into consolidation, first green day, but it worked into the high. First green day, remember, is a low of the day buy opportunity for an explosive move. We just saw the first red day opportunity on the Swiss franc, high of the day sell opportunity. First green day did not eventuate on the day, and I repeat this, if it doesn't happen on the day, pay attention to the second day after first green day. We get a break in structure just before the Asian session starts. It happens pre-market. Pre-market, that's a dead giveaway. Pre-market, break in structure, dump, and pump. Now, this was difficult to trade. There was, I think, Bank of Japan released, but it was a fairly large candle. It did follow through first bounce. Not the easiest to trade, but what happened afterwards for traders who came in the Europe-London window was the reversal. Now, this, again, is a inside reversal and becomes the all-day fade. So for traders who shorted this right at the beginning of the Europe Open, a fantastic opportunity. It gets more and more difficult to trade the all-day fade. It's an always in directional bias, and sometimes difficult to get in because you cannot gauge where to enter unless you're patient and use the timing window. New York Open, we had major red news, so again, first bounce, all you can do is trade in the direction of that bias. Once they get through to the previous day's low, that trade now has the greatest potential danger for reversing. Day 1, day 2, day 3. First green day, parabolic, vertical trade in the Asian session. And this is an example, British pound, where they triggered the high of the inside bar on Monday. So we have breakout traders in the market right at the beginning of the week, and they are immediately underwater. That became a first red day. Now this is really important. First red day is a high of the day short trade selling opportunity that does not eventuate. It does not eventuate, as we just saw in the Swiss franc. It's a pump up with, after a break in structure, pump up for the short trade continuation. This market goes sideways and breaks out. That's a pattern within a pattern. That's not a first red day trade setup. Remember, hindsight is about identifying the potential opportunity. So the potential opportunity would have shown us possibly a break in structure, and then the pump up first into the high of the day for the short trade down. It doesn't eventuate. So what that means is that, okay, we're not looking for the first red day opportunity. This market breaks out. If you're trading this, this now becomes a break in structure on the inside for the dump and pump setup. Now, this became a first green day on day 2. Monday, Tuesday sets our initial balance, our high-low for the week. That now is our rectangle for the Europe-London trend trade for one full range expansion that continued for 25 pip, again higher high that breaks down in the U.S. session open for the, if it breaks down first. Somebody asked me a question again, how do you know that the high of the day is locked in at 7:59 a.m.? I don't know, it's not locked in. That's my high though. If they go down before the session starts, think dump and pump continuation, but when they're forcing you to buy with the trend outside of the range, we've already broken out, you have to be suspicious that you are not buying into the third leg of the move. There's space where breakout traders have entered the market. No doubt that at some point this market has already locked in the high. We may now potentially be seeing a market that reach stop hunts into the breakout traders, or even a first red day opportunity that could set up for Friday. So vertical range expansion, this is the pattern within the pattern, the rectangle inside of the rectangle, the short squeeze, consolidation, and parabolic trend trade for a range expansion. The euro, we have a opening range high-low. Monday, Tuesday sets our range. Day 1, day 2, day 3, low of the week. Little W structure for the Europe Open. Engulfment pin hammer vertical move. We're inside of a trading range high-low. Market breaks down before pumping up into the high of the week. Pump up, engulfment, high of the week, high of the day, for the short trade back down. So critical to understand the opening range and initial balance. Oil, again, day 1, day 2, day 3. We have space on day 3. Market that keeps breaking higher, dumping and pumping. They put a high in place before the U.S. window opened. That's a dead giveaway. They were going to go vertical. As soon as they got back up to the high of the week, you should have already been thinking pump and dump. They pumped it up after news. There's nothing else on the calendar. The New York session spends 1 hour at the high before engulfing. Third hour pumps up before collapsing. And again, simple geometry, bodies high-low, measured move. 2 full expansions of the range takes us back down to the U.S. session low, 3-session setup. U.S., Asia, and London. New York breaks out of the high of the London session. False break. Reversal for a measured move back down on day 3. Day 1, day 2, day 3. Peak formation high of London. Peak formation low of the London session. So London puts in a low and a high. They break out and fail. The sell is at the high of the week, the high of the day. 3-session setup on level 3 on day 3 for a measured move down. Okay, gold. False break on day 1 Monday. Monday, Tuesday puts in our initial balance, our high, low, lower, low. First red day on Monday, lower, high, lower, low. And then the pump up, we talked about this yesterday, the pump up, first red day, gain. First red day, you want the pump up. Okay, if you're selling, you need to have the pump up for the dump. If you're buying, you want the break in structure, the dump for the pump. Day 1, day 2, day 3 blows off in the direction of the trend. Consolidation, higher high engulfment right at the Asian window, blows off. A pump and dump right at the end. We've talked about this before, day 3, a day 3 pump and dump. So if the market pumps up into the close of the session and goes into consolidation, this is a perfect setup. And again, we're in a broken down market for a blow-off move in the Asian session straight down to the low of Friday's breakout low from the U.S. session. The engulfment, and right at the breakout level of the low of the day, the Europe Open pin hammer continuation, smaller time frame. This was already coiled to go on the 5-minute entry criteria. So think again about what's happened here. They've triggered breakout traders. Where are their stops? This market goes vertical. It's all in, higher highs, higher lows. They get you going long in the U.S. window with the news. Trades up and gets traders who were short from Monday. Reversal trade. But it doesn't follow through. 1 hour at the high before engulfing at the New York Open. Engulfment. Smaller time frame. Entry. 5-minute chart. Other traders on 1-minute chart. Major round numbers. Double zeros. Quarter level. So 225 and 200. We're outside of the high of the day. Monday, Tuesday, right? 3-day setup. They go vertical, and then this ramped up volume. Somebody asked me what order flow is. When they build a market, remember, escalator up, elevator down. All of this is trapped, and it collapses. It defies logic. We have breakout traders in the market. Same thing we did at the short, the opening of the day. They had breakout traders in the market. They have breakout traders in the market long now, also chasing the move back through the high of the week, and their stops are possibly down at the low of the day. So, stepping back, it's not any crazy concepts. Day 1, day 2, day 3, high and low of the week, boxes, big box, trading range, trends, reversals, and trading ranges. That's all these are. But coming to the screen in your session, knowing where you're at in the day count and the templates, and then being able to plan, prepare, and execute a best trade setup if and when it is there. Step back, be patient, use the clock, understand the importance of the equity market opens. If the market has been open for an hour, or close to an hour, or you're heading into a new hour, and you're up high or you're down low, day 3, ask yourself, is this market showing strength or weakness? And then ask yourself, if you have an opportunity to enter, how will price need to behave? Should I add into this? Does it have potential to move? Understand the capabilities of when a market can continue in one direction. Know when, never, ever, ever to counter trend a market. So if you're looking to counter trend this market when it comes out of a day 3 high of the week short, There's no news on the calendar. You're into the New York session. Do not counter trend. Keep focusing on the highest probability opportunities. As I said yesterday, do not guess. Hope is not a strategy. The opportunities are here every single day. 3-day setups. Let the banks, the institutions, the hedge funds, let them set it up and then know when to pounce. Keep it simple, traders. Congratulations to the traders that nailed these trades. We're going to have more big trade opportunities. It will never stop. Day 1, day 2, day 3. Keep it going, traders. Keep it going. Keep it growing. Keep getting 1% better every single day. And may the markets go with you.